Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us for our Thursday edition, July 27th, the Market Insights and Observations. And we're going to go through the three topics we're going to discuss that markets are watching, we're paying attention to, we're positioning accordingly. So let's get right to it, and thank you for watching. Right out of the gate, we're going to talk about the soft landing. The Federal Reserve concluded a two-day meeting yesterday, raised interest rates. We're going to unpack that a little bit deeper. That's one of the topics we're going to talk about. The U.S. economy, the second quarter GDP was announced today, and it was a surprising number. We'll talk about that. And how to play the weakening dollar. U.S. dollar is now starting to slide and hit some key support levels. So let's talk about that. But inflation is moderating somewhat, according to the Federal Reserve Chairman Jerome Powell yesterday, who concluded the two-day meeting with a 25 basis points rate hike on the Fed funds rate, bringing us 12 times in terms of the last, even like just more than a year of rate hikes for the U.S. economy is now feeling the pinch. So what do we see? What's the key take-home points? I've got 2 or 3 slides here that sum it up. Bottom line is that you got a two-handed economist right now. On one hand, he has to wait and see what the cumulative effects would be doing to see how the consumer, how corporations, the net effect of all of the sort of tightening or pumping the brakes in the U.S. economy. On the other hand, how hot is the economy still? Look at the jobs market. Look at the key GDP data this morning. In case the punchline is it was up 2.4%. So U.S. economy grew in the second quarter this year a lot more than economists expected. So the economy's still hot. It's hanging in there. It's grinding through these higher inflationary input costs. We've talked about this several times. I've been on a lot of media sort of hits, if you will, discussing just that. The Federal Reserve sort of is in a predicament of sorts. And Jerome Powell didn't disappoint, actually had a pretty good press conference by way of saying he kept the door open to raise interest rates if need be, or lower them if need be. The good part for the Federal Reserve right now, I think the key takeaway is they've got some time. There's no meeting in August, and there's a couple of more data points, actually 4 key data points that come out between now and the September meeting. So what they have is they can see how this all shakes out. August is usually sort of a weaker month for the market sometimes as they're setting for year end, if you will, in September as well. But Powell basically said they're highly attentive to the risks of inflation poses, both sides of the mandate. And he basically will continue on his long-term goal of 2%. But they have a long way to go, and they have to be careful about signaling that they're basically done just yet. And he keeps going to next pages. FMOC is taking a data-dependent approach for the next foreseeable future, if you will. I think that's the key here right now, is the data-dependent. He fully moved into that camp. He fully gave the Fed ultimately optionality. I think markets took that with, all right, finally the Fed has the ability to say, hey, listen, they may be done, depending upon how the economic data plays out. If the Fed is done, then that's going to have effects on sort of the U.S. dollar. We're going to talk about that. But right now, they're going to see, he's still talking about the very tight labor market and then the impact on the consumer itself. Let's see here. But he also said that the Fed said, and this is one of the key headlines, who knows if this will be forever sort of remembered like inflation is transitory when the Fed said that. Yesterday, Powell says that the Fed staff is no longer forecasting recession. Now, if you remember, just about 99 out of 100 U.S. economists and economists around the world predicted and projected a recession for 2023. It hasn't materialized. The market has gone up. That's why you want to still expose to the equity market, because you never know, how the resiliency of the U.S. economy is going to be, how it plays out in corporate balance sheets, and how ultimately plays out into stock prices. And equity valuations are up, 30% on NASDAQ and 20% on S&P. I also said that the market's going to broaden out from just the tech stocks, the growth stocks, the NASDAQ stocks, a few weeks back. And the question is, where we see the industrials pick up, and we're also seeing the industrial pick up. That's a positive sign, a quality sign for the U.S. economy. Let's talk about the U.S. economy in just a second. But here's from the Federal Reserve website. Fed funds effective rate is the blue line here, and it's just marching up and ultimately projecting into the future, saying, hey, they're going to hold it right where they are. But the red line here is the Chicago Fed's national financial conditions. So they're predicting that the financial conditions in the U.S. economy are going to be more stressed in the future. So we'll see how this plays out. That means that the Fed would then have to then accommodate at some point in time if there's too much financial stress out there. Again, the key economic data today, U.S. Confirmed that the U.S. economy is still growing and healthy. The second quarter GDP was 2.4%, topping expectations, and despite recessionary calls. That's really key right there. Now, what's the cause and the effect? Well, if the Federal Reserve is done hiking interest rates, or even on pause, or maybe one more and done, and inflation is really slowing down because of all the tightening that the cumulative effect of the Fed has done, then the U.S. dollar right now is challenged. It's really below the 20-day, the 50-day, and the 200-day moving averages. Ultimately, it's a technical look of the support of, let's say, a stock, or in this case, we're looking at the U.S. dollar. And so this is a support line, and it seems to be not breaking sort of the top line support, and it's going to be breaking down. So if the dollar, and it's intuitive, right? So if the interest rates aren't supporting anymore by rising, rising the interest rate, if you will, the dollar then will start rolling over. So we could see a dollar sort of not 100%, going down tremendously, but we could see a weakening dollar for certain. Well, how do we position that? Well, oil and commodities are also confirming by bottoming out. Oil is bottoming out. We're seeing gas rise. We're adding energy again to our clients' exposure to our portfolios, as well as we're also seeing energy stocks get a bid in copper and industrials and commodities. Commodities is a big way. They're both back above the 200-day moving averages. Again, those are confident confirmations that we have to keep, not 100%, but we have to keep an eye on them, see if that trend continues, because that's a bullish breakout trend for the oil sector, the energy sector, as well as the commodity sector. But that makes perfect sense, because as dollar comes down, commodities are a good place to be as a hedge. What's another way to play the weakening U.S. dollar? Emerging markets, and they continue to firm up. This is a big key as the U.S. dollar weakening helps. We're seeing this trend, this bottoming trend, and this upward sort of momentum on the emerging markets. This is an emerging market ETF. It's above its 200-day and the 50-day moving averages. So it's sort of a breakout on a positive side. There's a lot more constructive work that needs to happen to confirm. But this trend could be a long trend and a way to play a weakening U.S. dollar. Again, another sign that outside the U.S. market, there are other markets to take a look at. We have international exposure. We're going to be adding emerging market exposure as this trend continues. And then this is from sort of the 7 sentiment studies ranked in the percentile categories and sort of where they are. The red dot is current. Actually, the current readings are right here in the blue sectors, and the earlier, if you will, you have the red dots. The sentiment dashboard looks very different from the start of the year, and basically just saying ultimately inflows, outflows, bull bearers, the put call ratios, the 10-day put call ratio. Ultimately, a lot of extremes ultimately from the market. So that's what we're seeing on the sentiment dashboard, and it's very different than the start of the year. That could change at any point in time. But ultimately, we're recapping what the Fed did. We're talking about how you could play this, and ultimately how you position your portfolio accordingly. And it's all on the Fed right now. They have the time is on their side to see how the data plays out and what direction they need to go. Either they raise interest rates in September, push pause, or they'll start lowering. We don't believe they're going to lower anytime soon. So it's either they stay put where they are and hold steady, or they raise again. But time will tell. But they have the optionality now, and that's it. Thanks for watching. We'll see you again next time.